Welcome to this special podcast on debt versus equity. I'm Dr. Victoria Clout. If you have already undertaken a finance course, then some of this may not be new to you. But if you haven't undertaken any finance courses, then you will definitely find this podcast of use. When a firm is considering using financing for funding a project or investment, they can choose between internal and external financing options. Internal finance will use the internally generated funds of the firm to fund that project or investment. The alternative is external financing. This includes equity or debt. While there are several different financing instruments available to a firm, they can all be categorized either as debt or equity. Furthermore, this is a choice that both private and public firms have to make. The choice between debt and equity is essentially a trade-off. It requires you to consider things like, do you want the holder to have voting rights and be able to affect the management of the company? Debt financing is for typically temporary needs. If money is needed for only 5 years, a loan can be arranged for that period and repaid. Shares, on the other hand, are generally permanent, indefinite life. Can you deal with debt covenants that will potentially restrict future debt financing and selling of assets? E.g., a company may be subject to a maximum debt ratio of 65%. So if they already borrowed a maximum of 65%, the company would have to use equity financing. Telstra has this opposite problem, and in the past, when it was controlled by the Commonwealth government and they held 50%, then Telstra would need to use debt to go beyond. In terms of Qantas has a restriction on foreign investment, so they must go to debt markets or try and generate more domestic equity interest. Do you want the holder to be able to participate in surplus profits? So a shareholder would be able to get an upside gain from great profits of the firm, greater than expectations, but a debt holder will just continue to receive their fixed payment. Did you want to have distributions that are discretionary or fixed? Interest and dividend payments are contingent on future cash flows, so you need to consider at what stage the company's life cycle is in. Younger companies generally don't have a lot of excess cash flows and therefore prefer a discretionary distribution based on profits and available cash, so they tend to opt for equity. Do you want to reduce your taxable income? This can be done with interest expense. And what's the effect on income? So, do you have profits? Can they be offset with the interest expense? There are three main decisions in corporate finance. Firstly, whether to make an investment, be it in a project, shares, purchases. The second, how to finance a project or investment. Consider, where do firms raise the funds for value creation investments? What's the mix of owners' equity, borrowings, or external equity? So the debt versus equity trade-off comes in the financing decision. The third is if the firm has owners or shareholders, when and if a dividend should be paid. And there's a trade-off in this between reinvesting the funds, the profits of the business, or returning capital to the owners. The simplest measure of how much debt and equity a firm currently has in its structure is to look at the debt ratio. The ratio measures the extent of a firm's leverage. Estimated as the total debt in the numerator, which includes short-run and long-run debt, and divided by debt plus equity, where equity is measured as the book value of this equity. So this is the sum of all of those items on the balance sheet, including share capital, retained earnings, reserves. The higher the ratio, the more leverage the company, and the greater its financial risk. There is considerable variation in debt ratios across industries, so it's best to compare firms within the same industry to see if they have a high debt ratio or instead of across industries. A debt ratio greater than 1 indicates that the company's debts exceed assets, and less than 1 means assets exceed debt. Notice the difference on the right-hand side. Debt must be repaid in a fixed way. While debt holders do not play a role in the management of the firm, they do not receive voting rights. There is a fixed date for the debt to mature, e.g. a 6-year loan. Interest expense is tax deductible, i.e. it goes into expenses which are deducted from revenues to give profit. So interest expense decreases profit, therefore decreasing tax, while dividends are not tax deductible. Equity is the residual claim on the firm, i.e. after all claims have been paid first in a winding up of a company, so the creditors, debt holders, they get paid, and then the shareholders of the firm. Shareholders have voting rights and can impact on management, e.g. voting for board members, voting for the bonus and remuneration packages of the senior executives. The equity holding is perpetual and indefinite. So as long as the company exists and has shares, there will continue to be shareholders. So it's not like a fixed maturity such as a bank loan. The choice for firms who are private is whether to list on the stock exchange, such as the ASX, and go public, or continue to stay as a private company. To go public brings benefits, such as being able to access larger sources of capital in the financial market, e.g. from the investors who want to invest in ASX-listed companies. If the original owners of the firm, when it went private, want to cash in their original shares in the company, they can do that if the company is listed. They can sell them on market. They may want to do this to diversify their wealth out of the firm. The cost of this option of going public is a loss of control. The new shareholders will be able to vote on management decisions. For public firms, there are much more onerous disclosure requirements, e.g. reporting under Australian IFRS in an annual report, having to adhere to Australia's continuous disclosure regime, and also the firm becomes subject to listing requirements, such as the ASX listing rules, which include disclosure and minimum levels of corporate governance. The evidence on management preferences on financing is that internal sources are preferred over external because of the potential difficulties of raising funds, e.g. an unsuccessful share issue. Management might be preferring to use internal funds to safeguard their control over the firm. With shareholders who have voting rights, this control may be diluted. To raise funds externally, this can be expensive. For example, a share issue requires a prospectus and typically an underwriter, which can cost the firm significantly. With debt financing, it might be money spent on drawing up contracts and in the negotiation process. On the other hand, compared to external financing, internal financing is limited, and so a firm will typically need to seek external financing, particularly to engage in growth in a startup phase. Debt has advantages over equity in terms of tax deductibility of interest expense, as opposed to dividends, which are not tax deductible. The firm has only to repay the debt holders the principal plus interest expense, while shareholders may expect to receive dividends and partake in the firm's upside prosperity. Debt holders are not able to interfere with the management as they do not have voting rights. The disadvantage of debt is that a high debt to a debt ratio will lead to greater risk and higher interest rates. The higher interest rate is necessary as the risk-reward trade-off for the lender. The higher the risk of lending to the firm, the greater the reward required. Two considerations also: bankruptcy costs and loss of future financial flexibility. If a firm takes on debts, this can increase the riskiness and potentially the probability of bankruptcy. By taking on debt financing, the firm decreases their future financial flexibility, as there is greater uncertainty about the future financing needs of the firm. This can increase the costs of debt financing. Some typical determinants that influence the firm's financing mix include where they are in their business life cycle. Some firms will be restricted by their position on the life cycle, e.g. startups would be more likely to use equity, while mature firms can access debt and equity markets more readily. And also they have access to internally generated funds, whereas the startup typically does not. There is a finding in the research about firms that comparable firms will take debt and equity in similar levels, such that will result in similar debt ratios. So this can be interpreted as industries typically having similar debt to equity ratios among the firms. Lastly, firms tend to follow a financing hierarchy based on their preferred sources of funds. In this way, they tend to choose down a kind of list of preferred sources, in turn using each up. Typically, this starts with internal financing through retained profits, i.e. past profits, as being most preferred, and then further down the list is debt and then equity financing. So let's have a look a little further at this hierarchy. So why is there a hierarchy that we observe in practice? This is because managers are keen to have flexibility where they can access external financing, and that can reduce the flexibility. So taking on debt can increase the riskiness of the firm. Managers also value control of the firm. Equity being issued means that new shareholders will have voting rights, and debt can come with debt covenants, where the debt covenants restrict management from undertaking certain activities, could be increasing a debt ratio over a certain level. The covenant is signed by management in exchange for debt financing. If they breach the covenant, it means that the borrowings will become payable within 12 months, typically, depends on the covenant. The breach of the covenant will also send a negative signal to the share market and typically results in a large drop in the firm's share price. Just look at ABC Learning as a fairly recent example. Here are the top 7 factors that chief financial officers in large US firms ranked as the most important in their financing decisions. Notice that financial flexibility ranks highly, followed by the survival of the firm, which has to do with the risk level. So you don't want the bankruptcy risk to be very high. The predictability of the source of funds and the share price. And then we have financial independence. We have the other 2 factors there, the debt ratios, debt rating, which is prepared by ratings agencies, and comparability with their peer group. So based on the survey conducted in the US, managers prefer to access firstly internal funds through retained earnings, which is past profits. followed by debt financing. Straight financing here in debt would be loans, bonds, then convertible debt. So which debts which convert into some shares, followed by external ordinary equity. So this is ordinary shares issued on a stock exchange, followed by straight preference shares, and then lastly convertible preference shares. These are shares that can convert into cash or convert into ordinary shares. So this concludes an overview of the debt versus equity trade-off.